If you own your own company, whether you're expanding your operations or simply staying where you are, one question has likely come up. Is it better to own our own space or to lease it? And that's a really good question. Of course, there are some intrinsic questions you or your management team first has to answer. Are we willing to pay for the stability of owning rather than renting? How quickly do we plan on expanding our business? How satisfied are we with our current locations, and is it even possible to purchase them? With prices being the way they are, it might very well be the best time to buy your own real estate. However, owning might not be the best option depending on what some of those intrinsic answers turn out to be. Why don't we take a look at a few well-known brands to see what their lease versus own model is. Starbucks and Chevron. Starbucks, the little coffee shop from Seattle that started back in 1971 and is now the largest coffee house in the world with over 17,000 stores spanning 50 countries. Starbucks is a company that expanded so fast that in the 1990s until about mid-2000, they opened a new coffee house every single workday. If you're ever in downtown San Francisco or New York, it's not that hard to find two Starbucks locations on opposite street corners. Now let's look at the Starbucks mode. Nearly all of their locations are in retail shopping centers or high-density office markets in downtown locations. If Starbucks bought their location, they'd have to buy the entire retail center or the entire office complex and manage them for investment, something that's not in their business model. Instead, they lease all their locations. Also, we have to know what Starbucks expects their net present value to be, as I explained in my Determining Net Present Value video. At one point, I recall reading that for every $1 Starbucks received from an investor through stock, they could turn and make over 25 cents to 50 cents with that same dollar in a single year's time. A company like that that's rapidly growing would always need to set their NPV over 25 or 50%. The reason they could set it at such a high number was because they knew they would create such a profit margin from just a single dollar. Most income property can make anywhere from 5 to 20% depending on location and risk. So realistically, what kind of property doubles in value every year? If Starbucks is making 25 to 50 cents in profit for every dollar received, they would have to find property worth buying that could do just as much. Considering how highly implausible that is, why would they waste their time when they could just lease out the space and keep expanding and making money? Now let's take a look at Chevron, a large company that is still growing but at a much slower pace than Starbucks due to their smaller profit margin. Without knowing the exact numbers, let's presume for every $1 they receive from an investor, they create 5 to 10 cents profit. A company like Chevron may not be able to demand such a high NPV like Starbucks does, but they can definitely demand a 5 to 10% NPV rate because they have the profit and they expect to make it. Chevron, of course, wants to grow and expand, but nowhere near at the pace of Starbucks. They just simply can't. They're already grown. So with their NPV at 5 to 10%, even if the property they purchase doesn't appreciate in value very much or make them a large return, it still may be worth it for the stability part. Can you imagine if Chevron rented some of their huge refineries and all of a sudden the landlord raised rents on them because the markets have gone up? What do you think would happen to their bottom line? Would they be able to really relocate a huge refinery like that? What do you think would happen to all the consumers at the gas pumps? What leverage would they have as a company versus Starbucks, who could simply pack up and move across the street if they don't like the lease rates? So how do we apply this to you, the building owner or the managers that's watching this? Well, as I said, first you have to ask yourself those intrinsic questions as an individual or as a company. What's the stability worth to you? What is your desired net present value? Once you determine these factors, you can then determine whether or not it's better to buy or lease a property. In fact, let's take a quick example. Here we have a building that you plan to move your business into, and you have two options. You can either buy the building for $3 million, or you can lease it for $12,500 a month with yearly escalations. Without getting into too many details, presume we need 35% down payment to finance the purchase price, and your NPV is about 7.5%. After 10 years, we are also going to predict around a $4 million sales price, give or take $500,000. Based purely on numbers, let's see which one is a better fit for you. In today's dollars, the lease over 10 years is going to cost you about $782,000. If you were to buy it and sell it in 10 years, the total cost in today's dollars is $776,000. Obviously, we're going to go for the cheaper one of the two, meaning it would cost you, the user, less money. But here's the cool part. We can actually use a graph to show you at what net present value the crossover between buying and leasing happens. In other words, let's say that 7.5 is an estimate. You think 7.5, but your partners predict a more aggressive 10%. Looking at the chart and going down from 10%, we see that leasing will in fact cost you less over 10 years than purchasing. Also, we see that the break-even between buying and leasing happens right around 7.56 net present value, which is right near what your estimated 7.5% is anyways. But let's say you're fairly certain about your 7.5 NPV and you know that that is a stable growth rate for you and your company. Let's say the big question is, what will the building sell for in 10 years down the line? Well, we can use a sales price sensitivity chart to determine at what price point is it better to buy or lease. In our scenario, so long as we attain a $3.98 million sales price or higher, or a little under a 3% growth rate, it will be more cost effective to purchase this property rather than to lease it. However, anything less and the lease is almost always going to be cheaper. Remember, the rule that buying is better than leasing doesn't always apply in business. First and foremost, you have to decide whether or not you want the stability and commitment of a large purchase or the flexibility of leaving once your lease is done. There's also financial issues in regards to if you have the capabilities for such a large transaction. These are just some of the questions that have to be addressed when considering leasing versus owning. Usually, if you're a business that is rapidly expanding, leasing is almost the common case that you should always go for. Whereas if you're looking for stability and modest growth, a purchase may be a better option. If you're wondering if expanding is right for you or what kind of data you can get when the time comes, be sure to watch my site selection video. Determine the negatives and positives of both scenarios and determine at which point you would feel comfortable with either buying or leasing. This way you can use your capital wisely to help your business flourish the way you see fit. Now that's good to know.